Hello, and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir, and I'm joined as always by David Broomfield. And making his debut on Need to Know this week, we've got Joe Aylott. He's an investment strategist at Coutts. Joe, I know you're a regular listener to the podcast, so you know the rules as far as we limit ourselves to 3 topics. I know we're going to be talking about gold today, but what topics do we want to cover? I mean, David, you're going to get one topic, so you go first. What's your theme that you want to sort of pull out on the subject of gold?
Thanks, Sarah, and hi, everybody. And thanks for asking. I didn't drink my investment portfolio since last week with Tim. It survived unscathed. But today, we're talking about gold. So for me, I want to talk about gold as a store of value, which I'm going to selfishly turn into a bit of a history lesson of gold, because I think it is a really interesting topic and it's changed remarkably over the last 6,000 years.
And it's a very long history, David. Have we got time?
Everyone's got 3 hours, right?
Okay, fine. All right, sit down, get yourself a cup of tea, make yourself comfortable, or a nice glass of wine. On that note, actually, last week we did talk with Tim Ellison about investing in wine. It was really fun to talk to him, and some interesting insights into wine as an investment or not, as the case may be. All right, Joe. So David's doing a sort of little bit of the history. What 2 points did you want to talk about?
Hi, Sarah. Hi, David. So I thought it'd be interesting to talk about gold as a diversifying asset and how it can have an interesting role in a diversified portfolio. And then the second thing I wanted to talk about was the recent rally that we've seen in gold over the last couple of quarters, and some interesting aspects to that rally that are slightly different from previous instances of gold rising.
Brilliant. Sounds good. And just before we get on to David's point, just another sort of pet subject of Need to Know that we haven't talked about in a while, surfing in the UK. I was actually at Rosylley Bay at the weekend in the Gower Peninsula. It's one of the locations we've talked about. I can confirm, even with the tide going out, it is a very, very good surfing beach. We haven't put this one to bed yet. I'm sure we'll revisit it over the summer. But anyway, for what it's worth, Rosylley Bay in Wales, extremely good surfing beach.
So I think we need a league table of surf spots, and we need to get listeners to vote on them, because if this is going to be an evergreen topic, I'm going to put my 3 top in there as well.
Okay, brilliant. But they have to be UK.
I'm the wrong guest for that. I think I've only surfed in Cornwall, and I'm not sure it was a location issue. Some of the issues I had with the surfing there. So not the right guess for that, unfortunately.
It was potentially more of a balance issue. All right, Joe, we'll park that one. Okay, so let's come to you then first, David. The history of gold markets, if you can condense it into about 5-10 minutes, that would be great.
Okay, let's talk about gold as a store of value, because when you think of gold, I think that's certainly what the ancient world thought of it. It's all about scarcity, and it's incredible. If you go and look at the numbers of actually how much of this stuff there is out there, not only in the Earth's crust, but how much of it we've pulled out and how much of it is still down there. Estimates vary wildly, but you end up coming out at a number of around 200,000 tons that's been mined, with about 50,000 tons left underground. Unless, of course, you enjoy those sort of conspiracy theories of mysterious cities of gold in South America and Japanese hordes of World War II gold in the Indonesian jungle. You come out with roughly those 2 numbers. And to bring that to life, if you took all of that gold that's been mined, you turned it into a cube, that cube would have sides measuring around 22 meters long. Right? That's for those listeners that have been into the Coutts Bank. There's a banking hall, an atrium. It would easily fit inside that atrium.
Doesn't sound like an awful lot of gold to me.
Incredibly scarce. And that's why it's been used for around 6,000 years. It's probably the oldest asset class there is. And it was first turned into a coin under someone called King Croesus, who I'm sure people know the expression as rich as Croesus, who was a king in Lydia, that's now Turkey, around 560 BC. And it was widely accepted all around the Mediterranean as payment. It was used to pay soldiers and used to do trade. So, that's a long history of being used in commerce, and a long history ostensibly as a store of value. And if you look at how much gold was mined from its first extraction around 6,000 years ago to the time when Columbus headed off to the New World, we only mined in that period around 13,000 tons. So that remainder up to 200,000 tons has only been done in the last, let's say, 500 years. Okay. And the big question out there is, okay, as a store of value, how does it do? How does its value change over time? That's my definition. I haven't got a 6,000 year data set. I mean, I tried. I found
Bloomberg doesn't go back that far, do they?
No, maybe I should ask them just to get some cogs whirring and see if people can get some data. But the data sets that are, I think, pretty robust go from around 1833 to 2005 and more recently as well. And if you look at gold as a store of value over that period, and I'm going to be very careful with my words, in real terms, so once adjusting for inflation, it tends to hold its value. So it's returned around 0.04% over that period. That doesn't sound fantastic. When you consider it against inflation, though, it's a pretty effective hedge. And for technicians out there or economists, when you look at it against US inflation, it's got a price elasticity, its elasticity with respect to US CPI is around plus 0.9%. Again, pretty effective inflation hedge. And I think, that's quite a robust study of the gold price. I mean, I found some wildly guesstimate data sets back even 1,500 years, and you see some incredible drawdowns over that period. I mean, I'm sure you're familiar, Sarah, with King Edward's edict, edict of expulsion in 1290, I believe. Gold saw a 50% drawdown after that.
Yes, I do remember that. Yeah. I think we did an episode of Need to Know about that.
Yeah, well, maybe if we didn't, we certainly should. But look, ignore that and let's look at it more recently against equities, shall we? If you look at it from 1990 to 2020 against a broad industrial index, let's say the Dow Jones, it underperforms by about 2/3 compared to the equities. But remember, that's not my argument. My argument is it's a store of value. But then you can find shorter time periods, 2005 to 2020, where it almost doubled in terms of its outperformance against the Dow Jones. It was almost double the performance of the Dow Jones. So, time periods, periodicity, very important when thinking about gold return. But over very long time periods, it does tend to hold its value in real terms. And that's really driven the financialization of gold.
Yeah. I was going to say, how important is the periods when gold has been used as the gold standard, whether it's Bretton Woods or the gold standard of the sort of late 19th, early 20th century? How much has that impacted the price of gold? Because obviously with Bretton Woods, they actually tried to keep the price of gold at a certain level, didn't they? And in the end, they couldn't. You had a sort of two markets in gold, essentially, didn't you?
You did. You had, the whole structure of Bretton Woods is only governments could effectively access that gold window with the US. And that meant you had two markets in gold. You had a sort of goldsmiths market, people making jewelry and trading in it. And remember, I think it was illegal to hold gold bullion as a US investor before, I think, 1975. We'll have to fact check that after the podcast. It was, it was pretty much the domain of governments accessing that gold window. So yeah, you had this two-tier market for many years. We'll come back to the gold standard. I think the other interesting point is, and particularly with this scarcity idea in mind, is that for the first time in that very long history, we're not recycling gold as much as we were. Yeah. And I'm sure, everyone who listens to this podcast might own something, even tangentially, that like a piece of jewelry or a watch that contains gold. Odds are that the gold in that item was Phoenician gold, Hittite gold, Greek gold, Roman gold, Assyrian gold. All this stuff was successive conquerors took their plunder, melted it down and remade it. And that was the story for thousands of years. More recently, we've been using gold not just in that industrial application, so jewelry manufacturing. We've used it now in electronics, and particularly as conductive material in semiconducting, microchips and connectors within smartphones. An average smartphone I looked up has 0.05 grams of gold.
Oh, really?
Some of that is being recycled, but the vast majority of it out there in the world isn't. So it has that, not only is it scarce, arguably with us finding more innovative engineering uses for it, and then not recycling it, it's getting scarcer. So I did say we'd come back to Bretton Woods. I think Bretton Woods is probably the most interesting illustration of gold as a store of value. And there's been lots of gold standards over the years. I mentioned one already. That's King Croesus's coins that were minted. That's literally gold coins. That's your first gold standard. The second one's a bullion standard. So governments hold gold bars that are redeemed with paper currency. And the third one, which was Bretton Woods, is basically the government holds currency that can be exchanged for gold. Nixon obviously ended that in 71. But the agreement around it, as I said, was all structured after the Second World War. Only governments could access it. And it was a US dollar system. Why was it a US dollar system? Because back then, the US had nearly all the world's tradable gold sitting in vaults. And most countries at the time didn't have dollars. So it was a bit of a problem. But the Marshall Plan and what happened after the Second World War sorted that with injecting dollars effectively into Europe. And what was amazing when I started to refresh my memory on this, isn't something really I've tackled since I was at university, that Paul Volcker, while he was at the Treasury, ran it. And he was, pretty much the lead individual accountable for the gold standard. But what was amazing is gold was literally moved around. It didn't leave the US. It moved between these incredible vaults in the New York Federal Reserve. And, many listeners might remember one of the Die Hard movies that makes this a central plot device. And you might think it's sort of a feature of sort of Hollywood imagination. It's not. All that gold was down there. It just moved from cage to cage as governments accessed that gold window. Now, obviously, the gold standard's no more. I won't go into why it was abandoned, but I want to tackle in my sort of concluding remarks this idea that I hear a lot, which is that unless a currency is backed by gold, it has no value. There's an article I wrote on Coutts.com that covers this, which is interesting if anyone wants to dive into it. But, the point here is that the dollar's role in global finance is obviously disproportionate to its share in GDP, and its trade deficit might very well be unsustainable, but that's not anything really to do with the fact that we use the dollar, and we shouldn't think that the fact that the dollar isn't backed by gold makes that situation unsustainable. It all comes down to this network of central banks that the Fed effectively run that create vast amounts of dollar instruments to allow effectively a floor underneath this big international muddle. And we all want that system to work. It's not dependent on what happens domestically in the US, so it can survive without being backed by gold.
Is it fair to say, am I correct in thinking that the dollar and gold are negatively correlated? So when the dollar goes down, gold tends to go up in value. Is that, I don't know, Joe, you're nodding your head. I think you've got some thoughts on that.
Let me I'll give you my 2 cents. I'll pass over to Joe, which he might have a different view. That's, if you were learning in a textbook, that's probably the answer you get. But it's not always that way. I mean, Joe.
No, I think that's absolutely right. Interestingly, this gold rally that we've seen over the last couple of quarters, that hasn't been the case, even though historically over long periods of time, that relationship has sometimes been used to explain gold moves. It's not the case at the moment, and I think that's a particularly interesting part of this gold move at the moment.
Okay, that's interesting. So we're saying then, and actually on the subject of gold-backed currencies, I noticed that Zimbabwe have announced that their currency is going to be backed by the country's gold reserves, although there are some question marks about whether they have sufficient gold reserves to fully back their currency. But it's an interesting move from them. You're raising your eyebrows, David.
Yeah, I'm raising my eyebrows because I think the crisis in confidence in that particular currency is something that's not about the fact it is or isn't backed in gold. Is more manifold than that. I think my argument is that when it comes to the major fiat currencies, they need to be backed by gold to make them worth something. And this idea of a store of value and the financialization of gold has obviously evolved over time. I mean, gold was incredibly inaccessible as an investor up until relatively recently. There are so many instruments out there now that are both linked to the physical gold or gold contracts, and they're accessible for retail investors. And that's a remarkable innovation that didn't exist only in the 20th century. You had to access gold only with a specialist bullion dealer or a specialist gold broker. And the financialization of it is correlated quite significantly with the price, certainly the recent price over the last couple of decades. So correlation doesn't necessarily drive causality, but there's a much different market on the demand side now than there was previously. And I think what's happening in the supply side now is quite interesting as well. Joe and I were talking about this the other day, weren't we?
Okay. So to sort of sum up your bit then, what we're saying, I mean, obviously gold, thousands of years of history as a store of wealth. It's been in its original form a money. It's been a coin. It's used in jewelry. It's now used in technology as well. And it does seem to, if we take into consideration inflation, it does hold its own. Yeah, Joe, you want to say something?
Yeah, that's exactly right, Sarah. I think it's not quite as robust or academic as David's numbers on the real return of gold being 0.04% over or since the 1800s. But the example often quoted by big advocates of gold is that the amount of gold required to buy a decent quality toga in ancient Rome is broadly similar to the amount of gold required to buy a decent suit in London now. Obviously, you can take these things with a pinch of salt, and I suppose it depends where you get your suits. You might get a suit and 4 shirts where I get mine, but broadly, that kind of is an example of what we mean when we talk about store of value and that ability to preserve purchasing power over thousands of years. That's kind of a practical example of what we mean, and that's clearly for investors who are concerned about or preoccupied about preserving their purchasing power. That's an interesting characteristic.
Yeah, I like the analogy as well. I don't know if it might stretch to a Savile Row suit, but a decent suit. So maybe if you could get bespoke togas back in the day, it might be comparable. Yeah. Okay, all right. Well, Joe, now you've started, you can carry on. So you're going to talk about the role of gold in a portfolio. Talk us through then. Why would people hold gold in their portfolio? We know it holds its value, but why else do we have it?
Yeah. So I think when you're thinking about why we might hold gold in a portfolio or as part of the diversified portfolio, it's important to be clear about what gold is and what it isn't. David touched on that a bit with the kind of comparison with equities. Gold isn't equities. Equity markets historically have shown an ability to grow their value meaningfully in real terms over time. And as David mentioned with his kind of numbers, that's not something that gold's done. However, what's particularly interesting about gold is that gold's a store of value that has historically had a fairly low correlation to equities. And so when we're thinking about diversification for investors, that low correlation with equities is quite important. I'll just explain why I think that's important or why it is. When we're building diversified portfolios, and equities are a big part of that, equities are positively correlated to economic growth and earnings growth. Yeah. And so but when earnings growth weakens or the economy weakens, you might see weakness in equity markets and obviously vice versa. So in a portfolio, if you can have some assets that aren't positively correlated or particularly sensitive to economic growth and earnings growth, that's an attractive characteristic, because then when your equities are falling or selling off, you'll have other assets that might be maintaining their value or increasing.
But traditionally, that would be bonds. They would fulfill that role, wouldn't they? But that's not the case at the moment.
Yeah. So yeah, that's a really, really good point. I think it represents a slight change in the kind of financial market backdrop versus kind of the couple of decades leading up to the pandemic. Because if you look at equity markets in that couple of decade period leading up to the pandemic, the big risk for equity markets were recession shocks, and that was when you saw weakness in equity markets. And in that kind of environment, bonds are the perfect diversifier, because when the risk of recession rises, you're likely to see interest rate cuts from central banks, and so your bonds will rise, and that meant you had that perfect kind of negative correlation between bonds and equities, which was attractive. The difference now is investors are starting, I think, to be to kind of face some risks that they perhaps didn't face in that pre-pandemic era. And there's a few of those. Geopolitical risks are one. Geopolitical risks aren't completely new to investors, but they are elevated at the moment. Fiscal risks are another, linked to kind of excessive government debt in developed markets or fiscally imprudent government policy, and even things like climate risks or energy shock risks. All of these kind of things are challenges for investors that they didn't really face to the same degree in that pre-pandemic era. And as a result, having more diversifiers in the portfolio does make sense in this environment. And I think that's where gold has a role to play potentially, because gold can protect you against some of those things in a way that government bonds might not. But having said that, that recession risk, which is still a big one, government bonds will still protect you in that outcome.
So, Joe, you make an excellent case on the sort of demand side for gold, why you would want it in a portfolio. What about the supply side? Because I think when we were talking about alternative asset classes, Sarah, last week, if you look at the gold market compared to, we were talking about fine wine, but if you look at gold, I think it's about a 5 trillion market. But if you think about the market as an investor, as a portfolio investor, it's about a 3 trillion market. And it's a big number. But to what extent does this scarcity idea and the players in the market have potentially an impact on the price?
Yeah, I think it has a huge impact. I think particularly because it means that scarcity element means that when you have new investors or new players coming into the market, they can have a bigger impact on the price. So, for example, we were going to talk about that rally that we've seen year to date a bit later, and I think a big part of the driver of that rally has been new buyers coming into the gold market, whether they be central banks in emerging markets, possibly retail investors in emerging markets, and that's not something that's new. Financial markets constantly have new sources of demand. QE, for example, when central banks started buying bonds, that was a new source of demand. The rise of buybacks in equity markets, that was a new source of demand for equities. The difference, I think, with gold is that it's a smaller market. So when you get a new player coming into the market, you notice it in the price much quicker, and it has a much more immediate impact on prices.
Yeah. So we've talked. So that's its role as a diversifier, particularly at the moment with equities and bonds sort of positively correlated. So it's an alternative. It holds its value, so it's seen as a good inflation hedge. But I also read somewhere that it offers deflation protection. How can it do both? Explain to me. On either of you, I don't mind who wants to jump in on this one.
Yeah. So I think that's a good point. I think it's a very interesting point. I think the reason that gold offers some deflation protection is that broadly, one way of thinking about gold is that it's a real asset, and so it's kind of competing with the alternatives, which could be putting your money in cash and earning interest on that cash. So when we move into deflation, often you see a large fall in interest rates because central banks are required to cut rates in order to try and combat that deflation, and that typically helps the gold price.
Okay. Yes.
And I think what's interesting, if you go back and look at those periods where you had deflation, significant deflation, and the gold price surged, they do coincide quite often with periods of financial instability as well, like the Great Depression, for instance. If you have this, falling prices, extreme periods of deflation, and then at the same time financial instability. Well, if you're not going to trust the banks or depositories with your money, what are you going to trust? You're probably going to trust gold. So there's a correlation there as well against protecting you against these systemic risks, these idiosyncratic shocks.
Yeah. And it's highly portable, isn't it? And I did read somewhere that you can actually melt it down fairly easily as well. That's the other attraction. Yeah, David.
Let's not confuse highly portable with easy to move around. I mean, it's 19,300 kilos a cubic meter. I mean,
that's
those guys,
point.
I'm not sure what they were driving in the Italian job, but I'm pretty sure it wasn't a spec mini off the production line.
That's a very good point. So, but also, I guess it's also seen as the crisis commodity, isn't it? It's the thing that it's the safe haven that people think about going into when they're concerned about what's happening in the wider world.
Yeah, exactly. I think how I would think about that is that the nature of financial markets is one that there's always a huge kind of range of potential future outcomes. And going back to what we said about the kind of changing markets over the last few years, that range of potential outcomes is possibly a bit wider today than it was maybe 5 years ago or 6 years ago. So there's more potential risks out there for investors. And on that, I think a lot of those risks are what we would call low probability, high impact events. So one kind of example of that that's intuitive is geopolitical risks. There's obviously a huge range of potential conflicts that could start globally that might not be high probability, but would have a huge impact if they did occur. And so obviously for financial markets, it's difficult to know how to price those risks or how to protect your portfolios against those risks because, as I said, that they're not likely, but they'd have a huge impact. I think that's where gold can, as you mentioned, the kind of crisis hedge, it can have a role to play in a portfolio in that environment because, as David said, it maintains its value over time. And also in those big crisis moments, it does then tend to deliver. So for those kind of risks that are difficult to protect your portfolio against, gold sometimes has a role to play there, I would say.
Okay. So is it fair to say then, and this is going to lead us on to your final point, Joe, about what's driving the current sort of price. Normally, what determines the price of gold is either supply, demand, or investor behavior. Is that a fair summary?
Yeah, I think so. I think on investor behavior, when we think about gold, you can get a bit more granular than that. So gold has, you mentioned the dollar at the start, gold has a couple of typical macroeconomic drivers. The dollar is one. The other big one is real interest rates. It's negatively correlated with both of those. So they're the kind of traditional macroeconomic drivers of gold that drive that investor behavior. And then obviously, yeah, as you mentioned, supply and demand has an impact too.
Okay, all right then. Well, so that brings us then to your final point, which is what is driving the current spike? I mean, gold's hit all-time records. What is behind that? Is it people are concerned about what was happening in the Middle East? What's going on?
Yeah, so as you know, Sarah, and as your regular listeners know, in financial markets, it's sometimes difficult to know exactly what's driving an asset price move, but we have theories.
I knew there was a theory coming, Joe.
Yeah, exactly. That's actually particularly true of gold because of some of the factors we've mentioned today. Gold can mean different things to different people, and so kind of isolating the driver of a price move can be different. But yeah, on the most recent gold rally, I think it's worth giving the context. We've alluded to it already that gold this year, but also over the last 2 years, has diverged from its traditional macroeconomic drivers. So they are real interest rates, which is negatively correlated with. That's hopefully quite intuitive. So if you think about real interest rates, adjusted for inflation. And so given gold is a store of value that doesn't pay you any interest when real interest rates are high, and you can be paid a high or positive real interest rate on your cash or your bonds, then obviously the hurdle to invest in gold is higher, and vice versa. When real interest rates are low or negative, as we've seen in the not too distant past, then the hurdle to invest in gold is much lower, and that leads to price rises.
Which is interesting because, I mean, everybody's anticipating rate cuts, but at the moment in the US, it looks like, I mean, we would started the year thinking we were going to have 6 rate cuts, which you think that's good for gold, but we're now looking at 2, maybe even 1. So you would think that gold would sort of not be performing so well in that environment.
Yeah, exactly. That's the real conundrum for the gold market at the moment. So as I mentioned, it's not being driven by those traditional drivers. We think one of the big factors that is having an impact at the moment is physical demand. So demand from central banks, demand from retail investors in emerging markets, and that's having an outsized impact at the moment.
Yeah, I think there's a couple of trends here. The first one is a sort of longer term structural trend, right? The financialization of gold and ETFs has definitely caused, if you look at the chart over the last sort of 25 years, you can see that demand by opening up these new world of investors into the gold market. But then more recently, you see those investors, ETF flows have actually been negative, but central bankers have been buying lots of it. China is in the center of the frame here, but you've got Turkey, Uzbekistan, India, Qatar, all of them have been buying gold. And that's quite a change, because in that modern period, post-Bretton Woods, although some banks, like our own central bank, have sold a lot of gold, others have bought gold. And if you look at central banks across the developed world, gold reserves have been remarkably constant until quite recently. It's only in recent years that you've seen that demand surge.
Yeah, I think that's it. I think central bank buying has really picked up, particularly in the last 2 years. So the data for things like central bank buying isn't as good as it is for some other things. But in 2022 and 2023, that really picked up. I think often in financial markets, Occam's razor is a useful principle that often the simplest explanation is the best one. I don't think it's any coincidence that picked up following the Russian invasion of Ukraine and the subsequent sanctions and asset freezes imposed on the Russian central bank. I think that had an impact on other central banks globally and caused them to reconsider the composition of their reserves and how exposed they might be to fiat currencies or US dollar or euro currencies.
I think that's spot on, Joe. We've got to we're navigating a delicate course here between, on the one hand, I'm absolutely resolute in my view that there's going to be no abandonment of the dollar system. Dollar hegemony is here to stay. But on the other hand, we've got to recognize that the US dollar is a geopolitical tool by the US to enact policy, and internationally to enact policy. If you're going to do any kind of sanctions enforcement, it will probably be through the SWIFT system, which is effectively the US system, or the US dollar. So, yeah, I think that's spot on, that central banks are looking at strategic reserves through that, at least partly through that lens.
Yeah, I think so. I think that's I think central banks buying gold, which is what we're seeing over the last couple of years and has driven some of the upside in gold, is interesting for a couple of reasons. One is that central banks buying gold and kind of holding gold on their balance sheet is likely to have a more permanent impact on supply of gold than if kind of an ETF investor buys gold. They might just change their mind the following day, sell their ETF position. I think central bank buying of gold has a more permanent impact on supply, in that they've made a strategic decision to increase their gold reserves. And I think the second point that's important around central banks becoming more involved in the gold market is that the gold market's relatively small, so it can have a huge impact. So as I mentioned, 2022 and 2023 were the years that saw a big increase in central bank buying. And because the gold market is fairly small and the kind of supply from gold mines globally is fairly constant each year, that has a huge impact. So net purchases of gold by global central banks in 2022 accounted for 30% of global gold mine supply for that year. And then in 2023, it was 28%. So it has a huge impact on the supply and demand dynamics.
I mean, we've talked about sanctions against Russia. How much are geopolitical events impacting central banks going back into gold again?
Yeah, so I think that's given the timing of when their purchases really stepped up, that's the most logical explanation. I think central banks are where we see it most dramatically, but it's also true to some extent of retail and individual investors in emerging markets, because they see kind of I mean, emerging market investors have tended to have higher correlations to gold throughout history, because I think periods of very high inflation or deflation have been more common in emerging markets, so they want some protection against that. But we're seeing some evidence of increasing demand from emerging markets on the retail side as well. But likely that's a secondary factor after central banks.
I mean, I don't know what the price of gold is at the moment, but last time I looked, at the time of recording, it was more than $2,400 an ounce. So what we're saying is that spike in price in gold is not perhaps driven by what we would traditionally view as what would drive gold, because interest rates are still quite high, and that normally you would expect interest rates to be coming down for gold to be more attractive. It seems to be it's central banks, it's a demand thing, and central banks are stocking up on gold at the moment, and retail investors to a certain extent.
Yeah, I think so. David mentioned ETF holdings earlier. They've been falling over the last year. They're back at, I think, their lowest levels since 2019. That's not typical. Usually when the gold price rises, holdings of gold in ETF rise too.
I think we need to balance the geopolitical events by their very nature. They tend to be relatively short-lived. Okay, we've got some structural wars going on at the moment that have been going on for a couple of years, but that fear effect and that crisis, flight to safety effect can drive the gold price, certainly. I think the longer term effects, as Joe sort of, when he discussed the various drivers of gold, it's more complex. And let's acknowledge that perhaps that we're going into a decade of more frequent geopolitical events. So that could, obviously that's your buy case for gold. But equally, the future is very uncertain. Maybe not. So I think that goes back to this point about correlation. But this isn't about making money versus equities. My very, very first point, it's about diversification.
Yeah, and a store of value rather than a place where your value is going to grow. It's where it holds its value. That's the important thing, isn't it? I guess one final point I wanted to come to then is we've talked about gold as a store of wealth. Let's look at a much younger, in relative terms, store of wealth, Bitcoin or cryptos in general. How do they compare, or how do they correlate with gold? Are they very closely correlated, negatively correlated? What's happening? I mean, we're not going to talk about Bitcoin because we're here to talk about gold, but I'm just interested to see the relationship between those two.
I think I can start, David. I think, I think there is some parallels at the moment, and over the last kind of year or two, they have been quite closely correlated, albeit Bitcoin is more volatile. Hopefully that shouldn't come as a huge surprise to people, because obviously some of the factors we've mentioned around gold, whether it's the scarcity or the perhaps difficulty or the ability of both Bitcoin and gold to maybe be more difficult to sanction or for governments to confiscate. I think those factors, that there are some parallels. The big obvious difference is that, as we mentioned at the start, gold has this kind of thousands of years of track record. You don't have that with Bitcoin. That's not to say that's not a bad thing about Bitcoin. I'm sure. Gold was a 15-year-old asset class once as well, but it is worth considering, I think.
I'll go way further out there and say I don't think Bitcoin's the new gold. I mean, yes, it does share some similarities. And if you look at its volatility dynamics with respect to gold and silver, there are some similarities, okay? But it's not this sort of safe haven asset, I would say. It's got fundamentally different properties. Bitcoin tends to have much more linkages with equity markets, and there's plenty of charts that we can show of its similar liquidity drivers to certain speculative parts of the equity market. The analysis that I've seen when it looks at the correlation of Bitcoin and gold shows it tends to fluctuate quite wildly from about minus 0.5 to plus 0.5. So there are similarities, but not a substitute.
Okay, all right then. So essentially, gold, store of wealth. We know that thousands of years of history. We've talked about the role of gold in portfolio. It's a diversifier, particularly as we're seeing at the moment, equities and bonds are very highly correlated. it's an inflation hedge, but it's also protection against deflation. It kind of does everything. We've talked about what determines the price of gold, but what we can't get really nailed down is what's driving the current rise in the price of gold. There are a number of factors, possibly one of them being central banks, but it's hard to really, there are theories about it. It's not really performing perhaps exactly as we would have expected in the current environment. Is that, to sum up, is that fair to say?
I think that's fair. I think there's been a slight change in the kind of dynamics of the market in terms of who's buying it, and that has an impact on the price. As you said, we have a theory for that, and I guess time will tell.
Yeah, all right. Thank you very much, David and Joe, for joining me. A reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. Thank you, I said, to David and Joe. Thank you for everyone for listening and for your comments, suggestions and feedback. If you want to listen to previous episodes, and make sure you're subscribing to Need to Know. Last week, we mentioned at the top of the podcast, we spoke with Tim Ellison all about wine as an investment, which is fascinating. And we'll be back next week with more Need to Know. We're going to be joined by Howard Sparks for our regular sort of quarterly look at US earnings, plus hopefully coming out next week, a very special episode in which I met up with Simon Kidston. And if you don't know who Simon Kidston is, he's the man behind the sale of the most valuable car in the world, the Mercedes Coupe, that sold for 135 million euros. So he has particular thoughts, quite robust thoughts on classic cars as an investment. So have a listen to that. That will be out next week. Until then, bye for now.